As I used to say, running a $20 billion portfolio, instead of asking people what do they think, ask them what's their trade, what do they have on, because their investment portfolio speaks louder than their words. So I'm going to tell you literally what I have on.
Thanks for joining us for part 2 of our interview with macro analyst and former bond portfolio manager, Alfonso Peccatiello. If you haven't yet watched part 1 of our discussion with Alf, in which he explains why he sees a pronounced economic contraction ahead, as well as a further decline in the stock market, head over to our channel at youtube.com/Wealthion and watch it there first. It sets the context for the investment perspective that Alf and I, as well as our partners in New Harbor Financial, share in this video. And please, just take a moment to support this channel by first liking this video and then clicking the red subscribe button below. Doing so will help this video reach a lot more viewers. All right, now let's get started watching part 2 of our video interview with Alfonso Peccatiello. So the markets are down about 10 to 12% so far this year, as you mentioned earlier. You're just speculating here, how much further do you think they could go down given your current estimation of how aggressive the Fed's going to be from here?
Yeah, so as I used to say, running a $20 billion portfolio, instead of asking people what do they think, ask them what's their trade, what do they have on, because their investment portfolio speaks louder than their words. So I'm going to tell you literally what I have on. I am short risk assets, a bunch of those. Actually, today, those are the Russell 2000. So that's the IWM ETF. I am short high yield bonds in America, US high yield bonds. That's ETF HYG. And I am short Bitcoin with a bit less conviction because it's not really working the way I would like to see the price develop in such a macro environment. The Bitcoin has been very resilient in the face of this, which I'm surprised about. It's working, but not that well. And then I have a position in the bond market, which basically positions for a flatter yield curve. So I expect short-term bond yield to continue go up, while long-end bond yield not to be able to go up that fast. So I don't care about how yields, which direction yields actually move, Adam. I just care about the slope of the yield curve, which I think is going to continue to flatten out. And we discussed why that is the case. Been having those trades on for a couple of months now. And my target for the S&P 500, to make it easy and understandable for everybody, is around about 4,000 or below that in Q2 this year. So we are now at 4,200, something like that. So that's about 200 to 250 points below, which would mean another drop of 7% from here, maybe 7.5%. That's where I think it's credible. And how do I work this number out? It's looking at earnings and valuations again. Investing, it's not rocket science, really. There are some rules and procedures to respect. But if I look at earnings in the S&P 500, the estimate for calendar earnings in 2022 is still around about 8 to 9% this year. I think that's too rosy, to be honest, in the macro environment we are in. So as earnings disappoint, I then look at valuations. And the S&P 12-month forward price earnings, so a valuation metric of price earnings, that's round about 18 to 19 at the moment, right? And so that's slightly above the 5-year average, and it tends to tell you the earnings yield, if you reverse this metric, that you will get by investing in the S&P and look at 12-month forward earnings, it's round about 5%. Now, 5% if front-end bond yields go up to 2% or perhaps higher, as we discussed, the Federal Reserve even signaling they can hike above this neutral rate, it's not that much of a buffer for risk premium, where risk premium is identified as simply, in this case, the difference between earnings yield you get by investing in the stock market against the yield you get by investing in a relatively safe Treasury short-end bond instrument. And so then I think the valuations of this S&P 500 also has to reprice a tiny bit down more, which makes me come to the final target of around about 4,000 for the S&P by Q2. So most of the drawdown we have seen already, from 4,500 to 4,200, I think it can drop a bit more, around about 4,000.
Okay. Is it fair to say that you feel like the market then sort of pre-priced in a lot of what you expect the Fed to do by already declining 12% to this stage?
Yes. So, which means that also the conviction in entering new trades, if I would have to enter all these trades today again at today's levels, my conviction will be lower than when I entered them at the beginning of the year, which means rationally, I have to be humble and realize that the easy ride, there is no easy ride in markets, but it has already worked for probably around 70% of what I would expect reasonably to achieve with these trades. I still ask myself, is the macro environment changed at all since you started these positions? The answer is not really. Has the market fully priced in what you think is reasonable? We're getting there. I think there is a bit more to go, which makes me still comfortable running the same short position in risk assets and positioning for a flatter yield curve in the US.
Okay. I guess the only question I'd have around, has the macro situation changed since you put those trades in, assuming you put them in back in January timeframe, is obviously what's going on right now with Russia and a little bit what's going on in China with the new COVID lockdowns there, because those are things that will potentially drive up the prices of commodities beyond where maybe you initially were expecting, which would keep inflation a bit higher and more persistent for a bit longer. Just tell me how that's changed your calculus at all, or if not, why not?
No, so that would make the Federal Reserve even more nervous. That's the point, right? As you suggested correctly, if commodity prices are more sticky than people thought, then these base effects we are talking about, where you start calculating inflation on the 2022 oil price, which is already high, then next year needs to be a bit lower, et cetera, et cetera. This effect tends to wane off pretty quickly because these commodity prices don't go down. They remain sticky on the way up, right? So this will make the Federal Reserve even more nervous that with today's forward guidance, with today's announced tighter monetary policy, that will be enough to drive down inflation to where they want to see it, which means they probably will feel compelled, Adam, to do even more, right? To react even more strongly in the face of a private sector suffering even more from higher energy prices. As wages in real terms are not increasing, but they are decreasing, and commodity prices are increasing, an American has to allocate more of his wages towards heating his house, filling his tank, et cetera, which makes his consumption habits already much more conservative. And then the Federal Reserve would say on top of it, wait a second, I need to go for it because it's becoming stickier. So what would that do to my positions? It would probably benefit those because the economy would slow down even further. Earnings would go down even a bit more than what I project already. And then the Federal Reserve, even be more aggressive, would put valuations even more under pressure. So from that perspective, I think it would benefit it. From the flatter bond yield curve, that's an interesting one, because if the Federal Reserve goes in and says, okay, we are doing this, but I don't want to see the yield curve inverting. I'm afraid of that. Everybody's looking at that. I don't want them to believe we're going into a recession induced by us tightening way too much, right? So what they would try to do there is engineer a steeper yield curve. How do you engineer that? I tell you how you do it. You go to a friend of mine still running a bond fund somewhere, and you tell him, all right, so from tomorrow, you'll have to absorb this huge quantity of long end bonds. Yours, it's yours. Find space and find a price at which you want to absorb these new bonds. You have less reserves, you have less money, if we can call that like that. You need to find a clearing price for those. You send it to the private sector. And so what the private sector would do would be like, whoa. If you want me to absorb all of that, then the only natural thing I can do is lower the price and increase the yield of these long end bonds. That's honestly, that's an artificial way to steepen up the bond curve, which has nothing to do with its true underlying dynamics, which are growth down the road, inflation down the road, healthy economic developments. This has to do with risk taking, with risk premium. So what you will be doing is making the situation eventually worse, because as the economy slows down, you're forcing investors to reprice risk premium starting from the bonds. The bonds are the safest part of the capital structure. So that would make it even worse, but it would temporarily steepen the yield curve, which would go against my position.
Yeah. All right. So this question is really a whole other interview in itself. So I just want your very top level reaction. But so, that's classic central banker interference, intervention in the markets. And as you said, it distorts price signals, right? Distorts natural market price signals. And I think we can make a really good argument that we're kind of in this problem largely because the Fed was distorting price signals for many, many years by keeping things way too accommodative, right?
Yeah.
So my question for you is, having lived in this world, right, where you were managing a very large bond portfolio and you interacted with these central planners, what do you think about their intervention? I mean, should we have a lot less? Do you think they're providing a needed role? What's your general opinion?
This is deserves a full interview, but to give you a top line thought, I was once at a very large conference in London, and there was a very senior member of the European Central Bank at that conference, and I had the chance to talk to him. So I asked him a question, and I said, look, can you tell me why you are always projecting that European growth will be 3%, 2%, 3%, and inflation will hit your targets? It eventually will, it never does, but you're always projecting that. Can you tell me why it's that? And he said, well, off the records, we believe that European potential growth in real terms is around about 1% or below that potential growth. And we think that achieving 2% inflation, healthy inflation, real wage growth driven inflation, consumer demand driven inflation, not supply bottlenecks inflation like the one we are seeing, but a healthy inflationary pressure, it's basically very, very hard. So we are fighting strong headwinds. Now, the difference is, what if I would go public with these statements? What would happen then? He asked me. And then we both laughed at it, but the reality is that forward guidance and communication is the most important form of influencing asset allocation and prices from a central bank, rather than its action, its true influence on its targets. Mm-hmm. Because if you're facing demographics, aging population, unproductive debt, technology, I'm sorry, but it's very hard to achieve this strong nominal growth that you're talking about. It's pure economics, it's mathematics. They can try to be accommodative, but the reality is, by projecting confidence, by intervening, by showing that they are there to support, they hope to prop up consumer behavior. That's really the whole gist of it.
Yeah. It's hard not to interpret those words, helping and supporting and intervening, as lying and deceiving. But there's that old EU quote, Juncker, I can't remember his exact title, but he said, "Hey, when it gets serious, you have to lie." Right? It sort of sounds a lot like that, and you can understand the pressure that these guys are in, and they can maybe rationalize it in their head, but it's hard, and I'm speaking for myself here, but it's hard not to look at that as the guy in the lighthouse seeing the tidal wave come to shore, and yet telling everybody on the beach that everything's cool, right?
Basically, yes, I have to agree with that. On the other hand, if you were them, I get this question a lot on Twitter, especially, also on the newsletter. What would you do, Alf, if you were heading the Fed or the ECB? It's a horrible job. I mean, let's be honest. All eyes are on you, despite your policies can't really do much when it comes to long-term growth, long-term inflationary pressures. Sorry, you can't do much about that. You are just the central bank is born initially as the clearinghouse of commercial banks. That's the most important job of a central bank, is to make sure that two banks can clear and settle their interbank payments via one big clearinghouse, which is the central bank. That's really the job that the central bank has in the first place. And then we move to monetary policy. But even then, again, it's the central bank has an impact on the short-term interest rates, but its lasting impact on long-term bond yields is much less so. Long-term bond yields are driven by what we discussed before: demographics, structural inflationary pressures, that technology. Central bank has no impact whatsoever on these dynamics, only second and third rounds effects, but all eyes are on you. So easy to say they're doing everything wrong, but to be honest, it's not an easy job.
No, it's not an easy job. And honestly, kind of to your point, I don't know who would really want it, but it's amazing that we give them so much authority, credibility, and really oftentimes let the world sort of hang on their decisions here. Alf, you're making me think it might be really interesting to do a panel discussion on Wealthion at some point in time, including you and some of our other central bank experts, on just sort of what the role of the central bank could/should be in an ideal world. Which is way more time than we have available to go into here. But folks, if you're interested in that, let me know in the comments below. And if we are, hopefully Alf can come join us for that. All right, Alf, a couple quick questions for you. So if you, by looking at the data that you have been sharing with us here, think that the bond market is saying the Fed can hike about, maybe 2 more percentage points, and then it's going to have to stop and then maybe cut in 2024. Then are you sort of, you said maybe you think your current short trades have about 30% of runway left. Are you then sort of expecting to then pivot at some point to going long again in anticipation of this pivot from the central banks?
Yes, but also, as I learned as well, if you want to, it's impossible to catch bottoms or tops. It's only for fools and liars, as my mentor would say, catching a bottom or a top. So in this case, I am short risk assets and in flatter bond yield curve trades. Those are working, and I think they still fit the macro environment. There will be a breaking point, Adam, where if my macro thesis is right, that the Federal Reserve is really committed, even the ECB seems to be more committed than usual, the European Central Bank, in making sure these inflationary pressures come back. If they are really committed, they have to tighten. When they tighten in an over-levered economy, just as a reminder, private debt plus public debt to GDP, so the overall leverage of the US and the European economy is above 300% of GDP. And GDP is not the right denominator, especially for the private sector. You should look at earnings, at cash flows, at wages, because the private sector needs to service this debt. It cannot print new bonds. The private sector needs to be able to service these bonds. It doesn't have a printer like the government does. They have cash flows, they have earnings, they have wages. So if you look at the leverage really of the private sector, something like 6 or 7 times, it's big, right? So when you tighten and you increase the borrowing cost for the new marginal buyer and his wage hasn't gone up, I'm sorry, but things don't square anymore. And when things don't square anymore, then generally speaking, central banks have preferred to rescue the so-called wealth effect. So I wrote an article on the Macro Compass called The Macro Endgame that explains how this works. How it works is that the wealth effect makes us feel, well, somehow a wealth illusion mechanism. My house prices go up, 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 and up. My mortgage is fixed on my balance sheet, and inflation eats away the real value of my liabilities over time, while my assets keep on going up in price. So if I mark to market my balance sheet as a private person who owns any asset and has any fixed rate debt, wow, I'm doing good, right? I'm wealthy all of a sudden. The reality is that this wealth is mostly driven by new credit at cheaper real interest rates. Now, reverse, credit is not flowing anymore and real interest rates are starting to marginally go up. See, mortgage rates have moved from 3% to above 4% in only 1 year. Now, if you reverse that, the wealth illusion mechanism becomes a wealth destruction, not mechanism anymore, but true wealth destruction. So the 401ks start to go down in price, which makes me wonder whether my early retirement was really a good idea, doesn't it? Right? So it makes my consumer behavior be much more affected. Generally speaking, central planners don't like that and want to rescue this mechanism, to provide the proverbial Fed put, where Powell says, this is the level effectively where I can handle it. After that, I'm going to turn and I'm going to pivot. That happened in the beginning of 2019. Do you remember? After 20% drawdown, Q4 18, Powell came back in 2019 to pivot. This time,
pivot, absolutely.
This time a bit different, because there are inflationary pressures. Will he be able to pivot if inflation is still at 5%, Adam? I mean, so to answer your question in short, I will be waiting, first play the macro game I'm playing now, being short risk assets. And before turning, I will be waiting for the Federal Reserve to tell me that they have changed their mind. So I don't want to catch a bottom. I'm not able to do that. Nobody's rationally able to do that every single time. I'd rather wait for cues and then balance out my risk reward trades.
Okay, great. Make Pal show you that he's serious before you start putting money to work at any sort of reversal. All right, and then lastly, you talked about sort of your current trade was, more you're definitely shorting the more speculative assets, but you sort of characterize the trend as a move out of risk assets and into safety. Yeah. I didn't hear you mention either long dated US Treasuries or gold. Can you just give your opinion on them real quickly?
Yeah. So let's start from long dated Treasuries and we end up with gold. So long dated Treasuries, as the yield curve flattens, then you would be generally thinking that buying long-term Treasuries is a good place to be. Unfortunately, although the levels, which are 2.5% today, reflect what I think being the neutral rate for the US economy to function, which means that long-term, if you buy US Treasuries at 2.5% and you wait long enough and you let the demographics play, the productivity play, the technology play, you probably will be roundabout fine in terms of entry levels. Tactically speaking, if the Federal Reserve decides to do quantitative tightening actively and sell bonds from their balance sheet to the private sector will have a hard time digesting those and will require a premium, which is higher yields. This is only a temporary phenomenon, but if you go long now, long and treasury bonds, in this potential dynamic, you are at risk, let's say. The other angle of this equation is that if equities keep on selling off, investors will be looking for a safety, a drawdown swallower, basically, and that can be 30-year treasuries at 2.5%. It provides enough buffer in terms of returns that these bonds could generate to offset some of the losses in the equity market. Now, result, I don't have a position. So if I don't have a position, it means I can't just go around and say if and or. I can tell you effectively why I'm undecided. And on gold, I also don't have a position for basically similar reasons. So if you expect real interest rates to go up relatively quick, then what you're doing is you are making the marginal cost of owning dollars less expensive. So if last year owning dollars was really expensive on a bank account, if the Federal Reserve raises interest rates and inflationary pressures start to dwindle away a little bit, then it becomes marginally less expensive. And as gold is priced in dollars, then obviously there is a cost opportunity, right, in owning an asset or owning the other one, dollar or gold. And if you make the marginal cost of owning dollars less expensive, people will prefer that on a marginal level than they prefer gold. This is tactically, cyclically speaking, right? Then there is a long-term path for gold, which is different, I believe. On the other hand, I also can't help myself to be short gold at these levels because the geopolitical tensions are completely unpredictable at this juncture. And although it seems we're working towards a resolution, it's far outside my control to be able to say, I'm going to sit short gold and be happy about it. If Russia and Ukraine can't find a solution, then I'm not sure I want to be short gold. Result, I'm neutral gold as well.
Okay, great answers. I just got to ask, because I heard you say it, I think you mentioned that you've got sort of a different long-term outlook for gold.
Yeah.
I'm just curious what that is.
The outlook is positive. So I have two portfolios, Adam. They're all well explained at the Macro Compass, how they work. One is a long-term asset allocation portfolio. The other one is a tactical portfolio, right? Tactical means 3 to 6 months time horizon. Long-term means a decade horizon, 5 to 10 years down the road. In this long-term portfolio, I do own gold for 8% of my portfolio. I think it's an asset that benefits from structural tailwinds and plays a very important tail risk hedge for my purchasing power. So the structural tailwind is that, as we explained before, our system is based on additional credit creation at each step in time. Structural growth is low. We don't like that. Therefore, we lever up. We lever up to feel we have more assets today than in reality we have, right? To make this sustainable, real interest rates need to be lower and lower and lower because wages are increasing. Earnings are going through the roof. If I want to borrow more, it needs to be cheaper. It's simple mathematics. and borrowing costs are reflected in real interest rates. And if you make real interest rates lower and lower and lower at each step, you will make the attractiveness of being invested in gold higher and higher and higher. So I think gold has this structural tailwind behind it, which makes it already a palatable asset. On top of it, it has quite unique convex tail hedge characteristics. Sounds difficult, it's not. What I'm saying is that this system cannot go on forever, or there is a risk, a certain probability that this system will find some breakage point at some point, right? Because if you try to lower real interest rates all the time, there will be a point where it's going to become very difficult to achieve lower and lower and lower real interest rates, right? When nominal interest rates are minus 1%, what are you going to do? It's going to become very difficult. When this becomes very difficult, people might start to think about another way to handle our monetary system. The other way we used for thousands of years was to make sure that credit creation was pegged to a hard asset. It's a completely different system. It's mostly deflationary because it's more difficult to expand credit in this system. But gold has covered the role of being the hard peg for credit creation throughout human history. And it sits already on the balance sheet of large institutions. It sits already on every central bank balance sheet, which makes it a go-to asset in case you would think of a probability of a monetary system reset. Therefore, it has some convex characteristics that might preserve purchasing power even in a very tail scenario. And therefore, I own 8% of my wealth in gold.
All right, great. Well, so it seems like we talked more earlier about your tactical portfolio. It'd be really interesting to talk to you more about your long-term portfolio. We've already way gone over time here, Alf, so we're going to have to earmark that for the next time we chat. Folks, if you're interested in that, again, let me know in the comment section below. All right, well, in beginning to wrap up here, Alf, first off, I want to give credit to the team at Doomberg. They were the ones who reached out and said, hey, you really need to get Alf on your program. And interestingly, around that same time, I'd had a number of people just in the Wealthion audience on YouTube send comments saying they wanted you on here too. So want to thank everybody that put you on our radar here. For folks that have enjoyed getting to know you through this conversation, and Alf, I think there's probably going to be a lot that did, where can they go to learn more about you and follow your work?
First of all, thank you for your kind words, Adam. They can find my work at the Macro Compass. It's my free newsletter, provides you with macroeconomic insights and investment ideas, as you heard me discuss with Adam. It's on Substack, so it's going to be themacrocompass.substack.com. If you Google the Macro Compass, you will be able to find it anyway. And then as well, you can follow me on Twitter if you want. The handle is @macroalf.
Alf, this has been a pleasure. I really hope to have you back on the program again soon.
Adam, I'm going to take you on the offer to do a panel and to do a follow-up interview on my long-term portfolio and anything else you want to discuss. This has been a pleasure. Thank you for having me here.
Thanks. You just made a lot of people happy. Okay, and now's the time on the program where I bring in the lead partners from New Harbor Financial, John Lodra and Mike Preston. New Harbor is one of the financial advisory partners endorsed by Wealthion. Guys, phenomenal discussion with Alf there. I know as he was going through his tactical portfolio allocation, I could kind of hear you guys nodding in agreement. But don't let me put words in your mouth. John, what did you have to think about what Alf had shared with us in terms of how he's been positioned here?
Yeah, Adam, we simply are broadly in agreement with his assessment. You know, he draws from a lot of depth of experience in the bond markets, which have always been viewed as the smartest, markets on the planet. Maybe they've been corrupted by the central banks, but they still are pretty huge markets, relatively speaking. So we've been preaching like he has, and positioned in such a way that we've been preaching limiting risk in most areas of the stock market, especially the most speculative parts, things like, high yield bonds, which are, stock-like bond investments that are, we saw the thinnest credit spreads in high yield, otherwise known as junk bonds, in history in recent times. And they've gotten whacked pretty good in recent weeks. Talked about a flattening of the yield curve. Incidentally, today, we actually saw an inversion of the yield curve. So worse than flattening, where, for example, 5-year interest rates are now slightly above 30-year rates. That's usually a very bad omen. That's usually a recessionary type of omen. which further plays into this feedback loop of potential risk in things like the stock market, which certainly aren't pricing in a recessionary kind of environment. So we do see further downside in these kinds of assets, and broadly agree with him. And he mentioned about kind of being a long-term investor in gold. We have been. We think gold is a very important element in a client's properly diversified portfolio for a lot of different reasons.
All right, great, thanks. And I'm glad you mentioned the inverted yield curve, because we've all been sort of waiting for that to happen. We could see the spreads narrowing and narrowing, and just want to underscore your comment there that the inversion of the yield curve, or as Lance Roberts says, the reversion after the inversion, are really kind of classic indicators that a recession, one of the best indicators we have that a recession is not very far behind. Mike, what did you have to say about Alf's portfolio allocation, and anything you want to put on in terms of what John said there, because then I want to get to a few other things that I want to ask you about here too.
Yeah, I mean, I enjoyed it as well. I mean, we agree with his short positioning on risk assets, even though he thinks that that story's been mostly played out. I think we might disagree with that. We think that assets have a lot lower to go, or at least a lot more risk of going lower. I think he said he expects the S&P to fall another 7% or so. The timing is impossible. We actually think that there's major risk in the S&P 500, and that it could literally fall by more than 50% from its high early in the year, or I should say late last year, or maybe even 2/3 or more. Valuations are far beyond any extreme we've ever seen before. So we agree with him on that. I think probably we just think that risk is even higher, perhaps, than he was talking about there. And he likes gold, and we'll get into that, I think, a little bit later. We do too. We like all real assets, and we're still playing it very cautious in terms of our equity allocation.
All right, and I did note that I just didn't have time to really dig into it with him. I did note that Alf's at least tactical portfolio didn't have too many commodities in it. All right, John, getting back to you, you had sent over a chart here I want to give you the opportunity to talk to, but it does, to your point, really show that the Fed is behind the curve here in a way that it has rarely been in recent history.
Yeah, really. So this is notable that today there was a Fed policy meeting and press conference where they announced, a 25 basis point, which is 0.25% interest rate rise, and the intention or the expectation that there'll be a total of 7 successive rise. So that would conceivably put short-term rates from, up until now 0% up to 1.75%. As drastic as that is and appears, with the backdrop of more than a decade of almost constant 0% interest rates, it is still dramatically underwhelming from the standpoint of what history has said interest rates should be to tap what is now becoming a very concerning an inflation problem. Most folks are very cognizant that whether at the gas pump or the food shelves at the grocery store, cost of living and inflation is really, really a serious issue. It's kind of unfortunate that I think our politicians are pointing to the unfortunate acts over in Europe with the invasion of Ukraine as the culprit for rising prices. It's completely obfuscating the blame there for really loose monetary conditions. But the chart here that we're looking at here, there's 2 lines. The blue line shows the headline CPI inflation rate, and the green line shows the Federal Reserve target short-term rate, which is essentially what people get at the savings bank or short-term rates. And you can see the gap between those is dramatic. And if you go back to the last time in history where inflation was running the rate it is now, that was in the late 70s, early 80s, and the short-term interest rate that the Fed sets was in double digits, not at 0. So they are way behind the curve. If they're going to fight the inflation, which it seems like they are recognizing they have to. They talked pretty tough game today. Some of the comments in the Fed minutes were that most participants feel strongly that they have to raise rates above what they call the neutral rate, that's serious talk for a Fed that for the last decade has said we're going to be very accommodative. So they're behind the curve, and we think they're needing to play catch up could result in a very vicious unwinding of the bubble that these low rates have created.
All right, and I really should have started this section by letting folks know that I'm recording with you guys a few hours after I recorded the interview with Alf. So in that interim period, we had the Federal Reserve meeting where Jerome Powell announced the first round of quantitative tightening and the first 25 basis points of rate hikes. So we did get what Alf was expecting we were going to hear today. And you mentioned that Powell confirmed that the Fed is looking at doing 7 rate hikes from here. That's assuming those are all quarter point rate hikes. That gets us to the 1.75% that Alf was saying the bond market was telling him it thought the Fed was going to do over the course of the next couple of quarters, maybe year or so. But as Alf mentioned, he says the bond market is currently telling us that once the Fed does do 1.75% worth of hikes from here, or from this morning, that the bond market's betting the Fed is not going to hike anymore and actually sees the Fed beginning to cut again in 2024. And this is, I think the rationale for that is very similar to a number of the guests we've had on this program, like Danielle DiMartino Booth, who basically say, Lynn Alden, same thing. A lot of other people have said the same thing, which is the Fed is going to hike until something breaks, and it's going to essentially be forced to pivot, and it's going to have to basically choose to either save, it's going to be forced to save the financial system and the economy, or it's going to have to step in and crush inflation. And I think people are betting that the Fed is going to eventually sort of pick the financial system and the economy and let the consumer and households sort of just fend for themselves with whatever inflation's doing at that time. Time will tell, but we're seeing a lot of data points, at least right now, that are agreeing with one another that probably get another 1.75% out of what the Fed's doing right now, and then it's kind of anybody's ball game after that. All right, so a lot of things have happened recently, guys, that I want to just quickly dial through with you. Mike, it's pretty amazing action in the Chinese financial markets today. Can you just tell us what went on?
Sorry, I think I was on mute. Am I back?
Yep.
Okay. Sorry. I have it on another screen and I'm trying to look at charts at the same time. So just tell me when I can go.
You can go whenever.
All right. Yeah, it's been pretty amazing in China, Adam. The Chinese government stepped in overnight and said, essentially, we're not going to let markets go down anymore. Or they say that they're going to be supportive of markets. There's a lot of different things they can do to do that. The details aren't that important, but the message was, we want to support markets. So the Chinese market rallied 22% today, which is basically the biggest one-day move since 2008, in like 14 years. So it's a massive move. If you look at the Chinese index or a proxy for the index, like ticker symbol FXI, you'll see that China was down, really hard over the last couple of months. And it kind of started with the whole China Evergrande situation. So you might say that China was oversold and the sentiment was really sour. So when they came in overnight and said they're going to support the market, the market soared. Now, whether or not that sticks or is a bottom, I don't know. It's probably not a bottom, but it certainly is a huge one-day move. And emerging markets, a sector that we like a lot, is and a proxy there would be ticker symbol EEM. It's 30% China, so that rallied hard. In fact, we own a position in emerging markets, and we've owned it a long time and hope to own that position for a long time more, and maybe even add to it over time, because emerging markets is really one of the few places in the world that's undervalued, in our opinion. So maybe a little bit of luck involved, but yesterday we removed hedges on emerging markets. We sold our puts on that position because it was getting short-term oversold. We can't take credit for this, but as luck would have it, emerging markets soared but 8% today because China, part of it, soared 22%. So it was a good move. There was a nice profit on the hedge, and we were able to take that profit. So yeah, it's been pretty crazy move there.
Wow. And, it's all because China basically went out and confidently stated, almost kind of like a Mario Draghi style, hey, we're going to do whatever it takes right, to support the system here. And that's not too dissimilar from the discussion that I was just having there with Alf about what he was hearing from the central planners when he was back in his position as a bond portfolio manager, where, as we talked about, a lot of times that they're just trying to sell confidence. Will their words ever be backed up with meaningful support that can sustain without creating other costs in the system? I think there's lots of ways to challenge that logic, but it doesn't stop, at least these days, from the markets just grabbing onto kind of any sunshine that gets sold their way and going off to the races. All right, you mentioned one of the trades you made this week, Mike. John, I'll come back to you for a minute, but I think that's not the only trade you guys did. So can you let me know what changes you're making to the portfolio, given all the action that's happening right now?
Yeah, I guess I'll answer that. It's okay, Adam. We did the closing of the hedge on emerging markets, as I just mentioned. Also, we've been watching yields. Yields have been rising. I'm talking about bond yields for quite some time in anticipation of the Fed raising rates. And so the 10-year bond yield has gone from about 1.7 to 2.2. The charts to us look like this was going to happen, and that yields actually could go a little higher, maybe 240, 250, maybe, I don't know. But we've been looking at yields. We think it's getting a little bit tired. It would be just like the market to say, now that the Fed has finally raised rates for the first time in a long time, let's at least put a breather in on rates going up. We think that's likely. Technically, rates are a little bit extended, 220 on the 10-year and close to 250 on the 30-year. And so therefore, we were looking for an entry in long-term bonds. And just yesterday, we did put a position on, a modest position in long-term bonds. We used an ETF that owns 20-plus year bonds and U.S. government bonds. And we hedged it like we often do in this market by selling a call option against it. It's a very modest trade. We're not really swinging for the fence here. This is a bunt or maybe a single attempt, not a home run. But one proxy for long bonds is TLT. We were looking at 130 or so as pretty darn good support on TLT. And then we saw the rates kind of getting stretched and hitting the target zone that we were thinking they would reach. And so we put a position on there. So those are the things that we saw our opportunity in this week. A long bond position, probably a couple months in duration, a short-term trade, and the selling of the hedge on emerging markets.
All right, great. And that kind of detail is wonderful, Mike. I know we have a lot of people watching here that really appreciate, getting a direct peek into exactly not what you guys are just thinking, but actually doing in your core portfolio there. John, I'll leave it to you to start tying things up here at the end of this week's conversation. You guys are talking to people many times a day, getting lots of questions, lots of concerns. What's the current vibe of the discussions you're having these days? In other words, what's top of mind for most regular investors these days?
It's tricky because I think what's top of mind is probably as volatile or changeable as markets have been. For example, we have we've talked about we've had and still have a precious metals allocation in miners mostly for clients, and those have seen a very substantial rise in recent days and weeks. But in more recent days, they've seen a pretty dramatic pullback, not nearly as much as has been risen. So we've seen some clients notice that that hey, their accounts went up, but then they pulled back a little bit, and it's natural that folks are tuned into their accounts very closely these days, and so up and down moves, and the down moves always are more memorable than the up moves, I think, for folks when markets are in a challenging environment. And we understand it. It's human nature, and we're obviously here to talk through that with clients. But we've had some pretty dramatic moves in the commodities in general. Look at wheat, for example, hit all-time highs, and it's come off probably 25-30% in just the last handful of days. So there's been a lot of air coming out of the real high spike in commodities, and we don't think that's over. It was probably what I would call a healthy correction to commodities markets that generally had gotten overheated in the short term.
Okay, good. And oil, we can go through a long list of commodities that really spiked high up until about a week ago and are down pretty substantially off their all-time highs. On gold, substantially, just because it's a good chunk of your portfolio and it's something we talk about a lot here. Yeah, let me just drill into that just for a minute. So gold, as you mentioned, the miners did really well because gold has done really well over the past month or so. And I think it was last Monday, so about a week and a half ago, we had an intraday all-time high for the price of gold, up around 20, you tell me, but 2075 or something like that. But gold today briefly cracked under $1,900 an ounce. I think it closed back around 1925 or so. Somebody might say out of concern, oh, the Fed's now raising rates. They're showing folks they're serious. That means that real rates are going to start rising. Does that mean we saw gold's top yesterday and it's all downhill from here? I don't think so. And I think even though, yes, real rates just got a little bit less negative, they're still deeply, deeply negative, almost the most negative they've ever been. But don't let me put words in your mouth.
Yeah.
What would you say?
I think that chart we looked at a short while ago, Adam, showing how far behind the curve the Fed is, really says a lot. Trying to play catch up on some modest rate increases, we don't think is going to be nearly enough to suppress the upside potential of precious metals because of how behind the curve they are. Quite simply, we don't think they can hike fast enough to stem the commodity inflation or the inflation that we're seeing. And when they start to raise even modestly, we think there's going to be tremendous stresses in the system, recessionary type reaction, which will likely pivot at some point again, maybe 2024, like Alf suggested, or maybe sooner, maybe later, but almost out of desperation, a reversal of course again in rate policy. And that is clearly supportive for things like precious metals, where yields or real yields start to decline again. So we're not at all thinking that the top is permanently in. It doesn't mean we can't see near-term weakness here, but we think the long-term story here is still very much intact.
All right, great. And do you feel that the current pullback in commodities, not just precious metals, but commodities, is this creating attractive entry points for people who maybe didn't get into some of these other commodities? I'll just toss out oil as an example, but it's just an example. Are we beginning to approach levels where people who maybe felt like, oh, I didn't get in this trade and then it got ahead of me last week. Well, now that it's pulling back, is this giving people a second chance in some of these commodities?
Yeah, I guess I'll take a shot at that. Yes, I think so, Adam. I mean, I'd be careful with the caveat that I'd be careful at dollar cost averaging into some of these positions, or with hedges like options, selling covered calls against them is always a good idea. But yeah, I mean, crude oil has had a vicious reversal, and energy is 60% of the CRB, or the commodities index. But a lot of these names have come back to levels that are more viable. We're watching very closely the broad commodity index, and it's getting to a level. I'm just bringing up the chart here that that makes sense. And I would say that you could probably start a position right in here with a small amount. We continue to watch it. We might very well do that. We're a little bit reluctant to get too heavy too fast in the area, because we already are big believers in gold and silver, and we tell our clients that having physical gold and silver makes sense. In addition, in our portfolio, we have gold and silver miners. Plus, we have at the moment an ETF that owns metals and mining, more base material metals and mining, or base metal. And on top of that, we have an oil service position. So really, and then of course, I just mentioned emerging markets, which are also, somewhat commodity dependent. So we have quite a bit of exposure there. So we're maybe more reluctant or slower than many of your viewers would be if they don't already have that exposure. So, but yeah, I mean, for us, things that grow in the ground or on the ground, commodities, raw materials, should be the place to be for the next 10 years even. And this is a good entry point to start thinking about those things. You maybe talk to a financial advisor if you don't know how to do it. Commodities are difficult to buy directly unless you have a futures account. You normally have to focus either on buying companies that produce the commodity or on exchange traded funds that hold futures. But there are opportunities here.
All right, great. And this is a great segue to something I wanted to remind folks about. If you watched, or actually particularly if you didn't watch the interview that I did a week ago with Rick Rule, we went very, very deep on the commodity outlook situation, but Rick reminded us all that he is putting on a online conference this coming weekend, Saturday, March 19th, that's dedicated to uranium, because he sees that as the commodity with the single greatest upside from here. And I think some of these price pullbacks that we were just talking about here make it an even more timely event to consider attending, because there's potentially a window here where you can get some of these companies a fair amount cheaper than you could just a week or two ago. So if you want to learn more about that conference, and as well as how to register, just go to wealthion.com/virtual uranium, and you can find all the details out there. As Mike said, whether it's you're thinking about maybe gaining some initial exposure to some of these commodities or commodities producers, or you want to begin to put into play some investments based upon the trends that Alf and I discussed earlier in this interview, we highly recommend, given the high complexity and the tremendous amount of volatility right now, that you do that under the guidance of a professional financial advisor. If you already have a good one, great. Do yourself a favor, send them this interview, and then ask them to sit down with you after they've watched it to explain how they are positioning your portfolio with the risks and trends, that the forecasts that Alf mentioned earlier on. If you don't have a good one, or would like a second opinion of one that does spend their days steeped in this material, feel free to schedule a free, no strings attached personal portfolio consultation with one of the financial advisors endorsed by Wealthion. Mike and John and their team at New Harbor are a key one of those. To do that, just go to, just stick around at the end of this video. We tell you how to do that. It's super easy to set one of those up. Again, totally free, no commitment to work with them. Lastly, if you want to see more great guests like Alf on this program, please do us a favor and support this channel by hitting the like button and then clicking on the subscribe button below, as well as that little bell icon right next to it. Well, guys, things are getting very interesting. The era of quantitative tightening officially kicked off just a couple hours ago. Whatever comes out of that, we'll be tracking it again here on this program week after week going forward. Guys, thanks so much for joining me today. I'll see you next week. Everybody else, thanks so much for watching.
Thank you, Adam. Really appreciate it. And we'll see you again next week.
Thanks, Adam. Had a great time. See you soon.
If you'd like to schedule a consultation with one of the financial advisors at New Harbor Financial, simply go to wealthion.com. These consultations are completely free, and there are no strings attached. The good folks at New Harbor will simply answer any questions you have about your investment goals or your portfolio and give you their best advice given their latest market outlook. They're willing to do this because they care about protecting people's wealth, and because Wealthion has connected them with so many thoughtful investors just like you over the past decade. We started doing this because so many people have approached us in frustration, looking for a solution because they're feeling out of alignment or downright ridiculed by the standard financial advisors who have been managing their money. You know the type. The kind that just pushes all of your money into the market, scoffs at the idea of owning gold, and when you bring up concerns about the market's sky-high valuations, they say, "Don't worry, the market will always take care of you." For many of the reasons discussed in today's video, we think this is one of the most challenging and treacherous times in history for investing. We strongly believe that today's investors are best served working in partnership with a conscientious professional financial advisor who understands the risks in play. Now, we're agnostic which professional advisor you work with, as long as they're good. If you're already working with one, that's fantastic. Stick with them. But if you don't, or are having trouble finding one you respect or trust, then consider talking to John and Mike and the team at New Harbor. Now, for those about to ask, yes, there's a business relationship between Wealthion and New Harbor, which we've put in place to make sure everything is handled according to SEC regulations. All the details on this are clearly provided on the wealthion.com website. Also, it's important to note that New Harbor is able to work with U.S. citizens, green card holders, and those with existing assets in the USA. But for regulatory reasons, they aren't able to take on non-U.S. clients. All right, with all that said, if you'd like some insight and guidance on how to protect your wealth during this unprecedented time in the markets, go to wealthion.com to schedule your free consultation with the good folks at New Harbor. Thanks for watching.